The stock market offers a remarkable opportunity to people who desire to create wealth for themselves and their loved ones. If you're looking to build wealth from an income stream which is totally passive, then stocks could be the perfect asset class for you to invest in. Welcome back to another edition of Clear Vision Finance. Our channel aims to deliver insightful and financially rewarding lessons which can help you to maximize on your financial potential. If you find this video to be helpful, please remember to like, subscribe, and post a comment. The global stock market is valued at over $40 trillion. That's an enormous amount of money to fathom, but it represents an ocean of opportunities which can help you move from struggling to triumph. To tap into this spring of wealth, you need to be disciplined, patient, and willing to learn. Fortunes are made and lost in quick fashion, so the investor who desires to build substantive and lasting wealth needs to recognize from the outset that the stock market is not a get-rich-quick scheme. With that being said though, it has created thousands of millionaires and it can do the same for you. One of the incredible realities about investing in the stock market is that it takes only one great purchase to change you and your family's future. The most fundamental and time-proven strategy for getting rich from stocks is to choose a profitable company and then hold your investment for the long term. This type of passive investing has the potential to make you very rich. But before we delve any further, let's cover some of the basics of stocks. For one, what is a stock? A stock is a financial instrument which represents fractional ownership of equity in an organization. When someone buys stock, they are therefore buying a share of the ownership in a company. By owning the stock of a company, you, the investor, are able to benefit from the financial performance of the firm. An investor earns money from stocks via two primary outlets: dividends and capital appreciation. When a company does well and it earns large profits, the directors of the firm will use the profits to pay off debt and reinvest in the growth of the business. But a portion of the profits is also paid out to the owners of the firm. This portion of the profits paid out to the company's equity holders is called dividends. Capital appreciation is a rise in the price of the stock of a company. Investors therefore make money from stocks when the price at which they either hold or sell a stock is greater than what the stock was bought for initially. Here are two examples which can better illustrate these two fundamentals. Let's say John buys 100 shares of Company X stock worth $1,000. Company X has a track record of generating good profits, and this trend continues after John's purchase. The directors decide after a successful quarter to pay out dividends of 5%. This payment of 5% is called a dividend yield. John would earn 5% of the $1,000 invested, which is $50, without being actively engaged in the management of Company X. In the second example, Mary buys 100 shares of Company Y stock for $1,000, that's $10 per share. The company continues to perform well after Mary's purchase, and more investors are interested in purchasing its stock. Due to the higher demand for the stock, the price rises to $15 per share. The 100 shares purchased by Mary increases in value and now values $1,500. Mary would have earned an additional $500 on her investment. From both examples, you should be able to see that dividends and capital appreciation represent genuine forms of passive income. They are also time-proven methods of building wealth. Hopefully, this video would have given you greater insight in relation to stocks and some of the ways that you can earn from them. Keep watching Clear Vision Finance to have access to more financial-based lessons and money motivation. Thanks again.